Beyond the budget. So I'm joined by a very distinguished panel on stage, and we also have Gregg via video link as well. So just to introduce the panel, so I'll start from the far end. So we've got Brian Henderson, Director of Consulting at Mercer. We've got Laura Myers, who's Head of DC at LCP. We've got Chris Hitchen, who's Chair of the Border to Coast Pensions Partnership. Rob Orr, who's Head of Technical and Communications at SAUL Trustees. And then via video link, we've got Gregg McClymont, Director of Policy and External Affairs at the People's Pension. So it's always great to see people in the context of their own home, but unfortunately Gregg is just sat in a hallway, so we don't really get much insight into where he lives. So I do think, though, that this phenomenon of actually having everyone join via video link, conference call, Skype, Microsoft Teams or whatever is something that we are going to be getting used to, even more so over the next few weeks. And actually that is kind of part of what we're going to be discussing this morning as a panel, because the overall context of the budget is the current situation. So how are our businesses, our pension funds, asset managers, consultants reacting to the virus? What information can we provide to our members and trustees on how we will continue to administer schemes? What's happening with investments? How is governance continuing to operate? And what communications are we sending out? So, for instance, I'm getting a daily report on how many people in our DC schemes are switching. It's quite interesting. Switching has gone up. More people are switching out of growth assets into cash, but there are a significant minority going the other way as well. And then, of course, I've got that information, but what am I going to do with it? And that's kind of another question. So, as well as the bigger picture, I'm also going to be asking the panel's view on the pension issues in the budget. So we didn't see the scrapping of higher rate tax relief, but we did see some other pension changes. So we saw the lifetime allowance increased as expected, in line with CPI. The tapered annual allowance remains, which is a real shame, would have been great if that had gone, but the thresholds have been substantially increased. So threshold income is now 200,000 rather than 110,000. And of course, this was explained as a measure targeted to support the delivery of public services, particularly in the NHS, but it does apply to both public and private sector. And actually, Carol Young from RBS, who couldn't be part of the panel today, made a very good point, because in the technicalities of this, we've also seen that the budget reduces the minimum level to which the annual allowance can taper down to £4,000 rather than £10,000. Now, if you do have a scheme that has a lot of high earners, or even just a small number of high earners, this is actually something that's going to be quite awkward to communicate, because this change comes in April this year. And then we're thinking about, how payroll systems are set up, what communications you will have sent out already to high earners. There isn't much time to talk about all of the changes that are happening. And I suppose it's just another example of tinkering, creating more cost and more complexity for businesses. And then finally in the budget, 2 consultations were announced. So the Rpi Cpi H Consultation, which amongst other things will cover the issue of timing. So when could the proposal be implemented if it's before 2030? And also covering some of the technical matters concerning that implementation. So, for example, increases in millions of members' pension schemes are actually very much hardwired against RPI. So moving to a different measure could mean that a lot of people get a reduction in their retirement income. Timelines are also really short here, as the consultation will only be open for 6 weeks and it closes on the 22nd of April. And then the final consultation is a call for evidence on the net pay relief at source issue. So there's nearly 2 million of low earners who don't get tax relief because they're in a net pay scheme rather than a relief at source scheme. And they, of course, don't have any choice as to how their pension scheme is set up, and they don't have any way of reclaiming any of this tax. And 75% of this affected population are women. So PLSA is very supportive of this call for evidence and really keen for the government to adopt a P800 solution, which involves the Treasury doing all of the work behind the scenes to adjust the tax for these people. And I'm sure Gregg's going to talk about this a bit more when we go to him very shortly. So that just gives you the overall context for the session. And the plan is, I'm going to ask all of our panellists to speak for a few minutes. So it'll be their reaction to the budget, but also their reaction to the bigger issues that we're seeing around how our businesses, pension schemes, etc., reacting to the virus and the market falls. And after everyone's spoken, we will take questions. And please do start sending in your questions as soon as you can, and I'll try and weave these into the session as we go through. I was going to ask Gregg to actually kick us off with his overall views on the budget. So Gregg, over to you now.
Thank you, Emma. Pleasure to be with you. I'm sorry I can't be there in person. I think the key thing that stands out from the budget on pensions point of view, and of course there wasn't a huge amount, is the way in which the government is really trying to dig itself out of a hole of its own making on the pensions tax relief taper by essentially redistributing quite a lot of money to groups within already the 1% highest earners in the UK. That's the best way to think about the changes to the taper. These are already some of the highest earners. We know doctors, it's been a big issue in the NHS, and the government's raised the thresholds significantly to try and solve that problem short term. But the impact is a lot more public spending, nearly 700 million by 2024-25, going in tax relief to the top 1% of earners. So I think that's quite a striking example of policy. More broadly, I think you covered the net pay issue impeccably, Emma. I don't have much to add to that. I think really the question is the urgency with which government attends to the review, the urgency to get the P800 solution in place. I think it still remains to be seen whether that urgency is there from the government's point of view. I agree it's a big issue, especially for low-paid women. On the budget, at a macro level, I mean, the extent to which the spending taps have been turned on is pretty remarkable. If this had come from John McDonnell in an alternative reality, the howls of outrage would have been strong, significant. Nonetheless, it seems to me at least it's the right thing to do, but it does take place in a context of very weak growth forecasts. So we have one of the biggest increases projected in net public sector borrowing on record, both for day-to-day spending and investment in aggregate, at the same time as really pretty worrying growth forecasts. I would gloss the growth forecasts as the impact of Brexit, which was long talked about, not least by economists, really is expected to come through in pretty very weak growth over the next period. And in the context of much higher public spending, I think that might become an issue down the line. Just two more things more narrowly. Firstly, the continuing bonanza to the Treasury from pension freedoms. Again, when you dig into the Blue Books, much higher revenues from pension freedoms tax take than expected. We really don't know who these people are. If they are individuals with significant DB underpins who are spending DC money, a bit like it's house money in a sense, then that's not a problem. But we really don't know enough about this group to judge that. So I would flag that as an issue of continuing concern. And then just finally, the pensions minister yesterday in the session, very strong on the role of pension funds in tackling climate change. The investment which the government is proposing in roads as part of its overall increase in infrastructure spending is really quite significant. And I would flag for further discussion how well that road building programme will fit within the government's wider mitigation of climate change strategy.
Thank you, Gregg. There has actually been one question that I would like to direct to you, which is why should someone who doesn't pay tax get tax relief? So back to our net pay relief at source issue.
Yeah, viewed in those terms, that's not an insensible question. I would view it from the point of view that auto-enrolment is a policy which aims to bring those who historically have had no pension savings into pension saving. We now have more than 10 million new savers through auto-enrolment, many of whom will never have saved in pensions before. And for the long-term confidence in that system amongst the public, and in the end, no system can maintain itself without a degree of public confidence, it just won't sit well with those who don't pay tax but are being auto-enrolled into pensions to not be receiving that boost to their pension income, which those who do pay tax get via the tax relief system. And also the unfairness that some individuals get it, as you pointed out, if they're inside a RAS system, but those through no fault of their own who are not in a RAS system don't. That unfairness has long-term implications for confidence and trust in the auto-enrollment system in particular.
Thank you, Gregg. Right, I'm now going to go to Rob. One of the other questions that's come in that panellists might like to think about is what would a good tax regime on contributions look like? So we didn't get higher rate tax relief removed, but what would our ideal scenario be? So just factor that into your comments as well. So Rob, over to you.
Thank you. So actually I agree with a lot of what Gregg said. I think just looking at the tapered annual allowance a little bit more, by increasing the thresholds by £90,000, actually that hasn't removed the complexity of that calculation. And so what that leads to from an admin perspective is it's difficult to calculate, but just as equally it's difficult to explain to members what it is and how it works. And actually with the government just tinkering around the edges, it hasn't removed that complexity and the difficulties people have in terms of communicating it. I also think actually that making a tax change from the 6th of April, which is only 3 weeks, doesn't leave an enormous amount of time for schemes to crack on and make the changes that they need to and to speak to affected members. So really not a lot of time there. The other thing I wouldn't mind just touching on is the RPI consultation. So the government on Wednesday issued a joint consultation between the UK Statistics Authority and Treasury. And that consultation is looking at proposals to use the CPI H method to calculate RPI. And if it goes ahead with those proposals, the date from which it might be implemented, which is somewhere between 2025 and 2030. Now, that will have an impact on lots of different stakeholders. As Emma said, from a pension scheme perspective, it may well mean that some members actually get lower pension increases going forwards because the reformed RPI will lead to lower increases. I think in terms of an impact on the value of index-linked bonds that many pension schemes hold, there'll be an impact there. And I also think that how inflation assumptions are calculated for pension schemes will be impacted. And actually with a consultation of this importance, to maybe only give 6 weeks for respondents to have a think about it and then reply, it does feel like quite a short period actually for people to be able to think about these important issues. And then I think your final question was around a preferred tax regime.
Yes, that's right.
Yes,
yeah.
Well, I think if it was up to me, I would probably move to a flat rate of relief for tax of around 30%, so eliminate higher rate relief. And I think from a personal perspective, that would benefit the scheme that I work for because actually it's mainly low to moderate earners that are in that scheme. So that's probably what I'd do.
Great, thank you, Rob, for that vision. Chris, can I move on to you for your overall reactions to the budget?
Sure, well, I suppose I'd endorse what Rob just said, actually. I mean, that feels like... I mean, it's always been a misnomer to talk about tax relief anyway. I mean, it seemed to me, at best, it was always tax deferral, right? And it really is, as Gregg was saying, a matter of incentivising long-term saving. That's what we're trying to do. So a fairer way of doing that, particularly for your members, and with one of my hats, I'm a trustee at NES, for instance, that's probably greatly to be wished. Although I was chair of the PLSA back in 2008 when we had some market turbulence as well. And I seem to remember then, actually, we were worrying that government was going to get rid of high rate tax relief, and we were lobbying furiously. So, some things don't change. And certainly in market terms, we seem to be right back where we were. But I suppose if you'd told me then that we were going to have one of the longest bull runs in history between now and 2020, well, I'm not sure many of the people in the room would have believed it, actually. So it's been a very strange decade in that respect. So I am the chair of Border to Coast Pensions Partnership, which is one of the local authority consolidators. We have 12 local authority clients across England, slightly more concentrated in the north and east, but we have authorities over most of the country. We haven't yet taken over Scotland or Wales yet. By the way, I do wear another hat as a chair of the Pension Super Fund, so I was pleased to hear what Guy Opperman said yesterday. I think consolidation in all its guises is probably greatly to be wished, given the current state of our industry. But with my border to coast hat on, we're effectively we're managing assets for our clients. We're wholly owned by them as well. Fortunately, from our point of view, they're pretty long-term in their approach. So I don't get the impression there's much panic at the moment about what's happening in markets. They'll very much look to trade through. And by the way, for many schemes, market reductions are a good thing, right? Particularly for Nest or the People's Pension say there's a lot more value in future contributions if you can buy assets at a reasonable price. So it's not an ill wind that blows nobody any good. But as I said, my local authority customers are really pretty long-term in their approach. Right now, I think they'll be much more concerned about the real world as opposed to the financial world. For several years, they've been concerned about how to deliver local services on tighter and tighter budgets, I guess, and adult social care in particular will be at the sharp end of the forthcoming crisis. But they're very pragmatic and practical people, and they're used to finding solutions. So I've already heard that they're talking about repurposing librarians, for instance, to provide advice to older people on subjects other than which books to renew, which is a very sensible way of using the resource, I would have thought. With regard to the budget, I guess my clients will welcome what the Chancellor said around infrastructure and housing. They're generally well disposed to actually investing in those things themselves, provided they can do so on a relatively diversified way, I guess, for my client base. So we'll really look forward to seeing what comes forward there. The Chancellor, by the way, he was the Minister for Local Government only 6 or 7 months ago, so we feel like we know him well, and he's undoubtedly a rising star. I thought he gave a very accomplished performance in the budget. And generally speaking, I guess, I don't often react terribly favourably to what governments say, but the measured response of government to the COVID-19 situation so far, I personally think is a good way to go. There may be different views on the sofa, but I'm quite concerned that other governments are causing the whole world to come to what used to be called in emerging markets a sudden stop, and it seems to me the economic effect of that could really outweigh the benefits.
Thank you very much, Chris. Great. And one of the questions that's come in, so I'll throw that to Laura and Brian for their bit, is in the year when the UK hosts COP26, should we have expected more from the budget in terms of green measures? So, what about that much-rumoured green sovereign bonds, for instance? What would the panel like to see from more of those measures as well? So I'll throw that at you, Laura, while I then also ask you for your overview of what you thought of the budget.
Yeah, I think from a climate perspective, people were expecting more out of the budget. It was positive to see, there was some tax related to plastics, the reduction on red diesel. There was a few positive measures, but no, I don't think it really hit the mark in terms of what people were expecting from a climate perspective. Did you want to say anything, Brian, before I move on to my views on tax?
I don't want to hold up your views on tax. So I've got thoughts on it, but you crack on.
Cool, thanks. So to answer the next question on kind of tax, so if I'm thinking about it from a DC perspective, I definitely think there was a missed opportunity. The net pay rise, it's really great to see that that's actually in the budget at all, so really positive. But I think it's a little bit disappointing to say there's going to soon be a call for evidence. It feels like we're going to be here at least another year later with people in exactly the same position, that they're missing out on 20% of their pension pension pot, just because unfortunately they're in a net pay scheme and not a RAS scheme, which is, as you were saying, Emma, is absolutely no fault of their own. It's just where they've been auto-enrolled into. So I think that's a little bit disappointing. And then kind of echo what you were saying on the tapered annual allowance. It just, again, feels a little bit like, great that loads of people have been moved out of that and that there's not complexity, so there's less to explain. But actually for my schemes, there's quite a few that have either members have opted out, so they'll be missing out now. Potentially they could have, you know, more pension savings, and all the complexity around you're going to have to change all your systems, your communications, if you've put in kind of caps of members only having 10K, for example. So I appreciate this only impacts the higher earners. It's just more work, more admin work for those of you that are running pension schemes, which I think is just disappointing. I think abolishing it altogether would be my favoured tax regime. So really, I kind of echo having something simple that you can explain to members in a sentence. Pensions tax is just far too complicated. It puts people off, even though a lot of the complexity is around the higher end. I just think people are quite nervous and don't really understand pensions, and just adding all this complexity doesn't really help at all. So I do think there's a slight missed opportunity in this budget from that perspective. And then to talk about some of the things that you talked about, Chris, on kind of the broader market from a DC perspective. Obviously, there's been quite a lot of volatility, and from a DC member's perspective, like, people will be worried. As Emma was saying earlier as well, people are phoning up, asking questions. You're seeing people taking investment decisions. So I think we need to think exactly how robust our DC investment strategies are, particularly when we know people are accessing their pots far before their target retirement age. So if you're still not de-risking before 55, I think you should start looking at your investment strategy, because actually, if people are overly invested in equities, because you're assuming they're going to access at 65 when actually they're accessing at 55, there's a real mismatch there. They could be heavily invested in much more risky assets. So thinking about your de-risking periods with your investment strategy from my perspective really makes a lot of sense. So lots of education and communication is probably needed in these times of market volatilities with members. But I think it's not just those kind of broader investment strategy points. I was speaking to the panel earlier today and actually saying that I've been on a call this morning about an asset transfer that's potentially not going to go ahead because of the market volatility, and particularly because of it impacting kind of business continuity plans. So really needing to think about actually what you're doing with asset transfers and change in investment strategies. Is that a kind of a key operational thing to do right now, or is it something that we should be pulling back on? So I think actually it's a really unusual time at the moment.
Thank you, Laura. Brian, your comments, please.
So I guess if we didn't have COVID-19, we would be anticipating more of a climate-based budget. I think we've been anticipating that for a while, and but it's kind of fully understandable. And picking up your point about what clients are doing, I mean, just a client that was doing a funding-based trigger a couple of weeks ago, we had to pull them. And so there are some challenges. And for my sins, I was asked to look after our COVID-19 response for the wealth business at Mercer. And so it's been a busy few days. And I just to put it in some context, I mean, there's a lot going on beyond just what's happening in the markets. And so if you look at, say, from a risk tolerance perspective, the market opportunity, the member comms, business continuity, governance, and how you tackle things like longevity, there's a lot of areas that are affected by this. And so we've pinged something out to our clients, and we reckon there's about nearly 50 actions that they could be taking right now. And I'm just going to highlight a few of these, because I think trustees might not have picked up on some of this stuff. So if you think about it from a covenant perspective, I was speaking to one of our actuaries this morning. They're saying, I've got a client that's on, there's a chance of insolvency, kind of a fly-by event. Yeah. Covenants under some stress for some clients. Some will be weaker, so maybe a light covenant check might be required, but those that have got some real financially stressed covenants and may go under, then you maybe need a more stricter sort of look at the covenant in the first place. I think the message here is kind of speak to the sponsoring company and get that dialogue going. On the market opportunity, just a couple of things. There are opportunities when markets do these sort of things, but a lot of DB trustees, final salary trustees, will have cash flow requirements, and you might be selling distressed assets at the moment. And so just a little hint that you maybe want to have a look at your cash flow policy again, just in light of what's going on. If you're maybe making any big strategic changes at the moment, there's now the time maybe just to reassess that. We might, for example, interest rates could be low for a lot longer now. And so if you've got hedging in play, you probably want to go back and just make sure that it's ticking along the way you expect it to. From member side, the one that jumped out at me, and again as trustees in the room, and maybe corporates as well actually, you may need to think a little bit about transfer values. You might be sitting with members that had quotes back in February about to take up these offers. So there's some challenges around that, and I would urge trustees and to have a look at that and say, look, should we revisit it? Should we maybe even suspend transfer values? It might be that bad. The one that's jumping out, and I've had loads and loads of client questions about this week, and it's all around business continuity, and particularly around administration and disruption to administration. And so the challenge here is to ask your administrators, how do you cope? Can your administrators work from home? Is that a possibility? Or can they not? And the administrators, of course, are pushing back and saying to companies, can your payroll cope? So you can see there's a bit of a dynamic going on here that potentially could break down. If you get in-house pension administration, you really need to think carefully about widespread illnesses and absenteeism and how you deal with that. The other couple of areas, sorry, and I'll shut up, is this is a bit about trustees. Now, this came up the other day there, so trustees might not be able to make meetings, you might not have quorum. Check your scheme rules here. It's all very well to say, what we'll do, we'll do it by video, or we'll do it by telephone, but your trustee might not actually let you do that. You might have to have face-to-face meetings. So just to put it out there, that you maybe need to check your trust rules and deeds to make sure that you can actually do that. And then finally, just a couple of things. Again, back to DB, you might be doing some buy-ins at the moment. That's very popular at the moment. I would suggest you go back and you look at the pricing. Certainly if there's a potential increase in deaths, I know this is horrendous to talk about it, but potentially the pricing in your buy-ins could be better. And so if you're going through a process like that at the moment, I'd suggest you revisit it. And so that's just to give you a flavour. There's about 50 of these things you need to talk about and think about at the moment. And I dare say by, like the virus itself, it'll be 100 by the end of the week. Just making the point, right? There's a lot to be done.
Yeah. Thank you, Brian. Yes, I've got a question coming immediately saying, is suspending transfer values actually legal?
Good question.
Good question. Yeah, all of these things need to be thought about. So some of the other questions that have come in, they're really around the kind of tax regime stuff. So, one good question here, why would higher rate taxpayers pay into a pension if they're taxed on contributions going in and on benefits coming out? Where's the incentive there? Are we effectively disenfranchising the higher earners from pensions, high rate taxpayers? What did the panel think about that? Yes?
Yeah, I think that is a problem. And I think that consequently, from a DC perspective, it just means that the people in boardrooms are often potentially not interested in the DC pension benefit as much as they potentially used to be. They don't really get as engaged with it when it's not personally impacting them, which I know is a terrible thing to say, but we've seen that all happen already. So I do think there is some slight concerns there.
Yeah, I always feel it's better if you're actually a member of that scheme to really mean that you're aligned and caring about it. So I think it would be an issue there. Another one on similar lines. So, why is it that when the highest paid doctors make a fuss, tapered annual allowance gets changed, making the rich richer, yet campaigning to widen the AE thresholds, financially include lower paid earners, has largely fallen on deaf ears. So we have got the promise of net pay RAS, but what do we need to do next to reform auto-enrolment, improve that? Gregg, I don't know if you've got some views on that.
Thanks, Emma. It's a very good question. I mean, the answer is, of course, that the NHS is the #1 political issue. So that gave the issue with doctors, obviously, a huge amount of leverage. The broader question, of course, is very fair. How does one build momentum and support for a campaign to improve the position of a broad mass of the pension saving population who tend, as a rule, not to be so noisy and keen on making a fuss. We have the 2017 review, as we all know, which the government has endorsed. I don't think there's any easy answers in terms of having those recommendations implemented. It takes the building of pressure by the pensions community as a whole on government, understanding the constraints which politicians are operating under, as well as being very clear in the benefits for the saving population. So just to give one example, we certainly think at People's Pension it's a very good idea to remove the earnings, the band of earnings threshold and go from first pound of earnings. I think we do have to be careful about how that would be implemented. Should it be done in a phased manner to make sure that the impact on the low paid EE savers isn't overwhelming and leads to a big spike in opt-outs. So I think that combination of sensitive and sophisticated campaigning by the pensions industry at the same time as understanding the constraints that politicians are operating within, and to get a solution, to get things done over the next 2, 3, 4 years is probably a reasonable assumption.
Is it worth adding that kind of the PLSA is doing quite a lot of lobbying on this as well? It is an issue that we talk about regularly in our policy boards. So it's something that is high on our agenda to pushing it forward with government, etc. It is something that I think the industry very wants to change.
It's quite complex though, isn't it? I mean,
Yeah.
if someone's doing 3 jobs and then in a different scheme for each job, then that's one situation. Whereas if they're doing one job but they're low paid, that's a different situation.
And also if they're self-employed.
Well,
and unfortunately, it seems to disproportionately affect women in lots of these, as you say, with the multiple part-time jobs.
Yeah.
So it needs a reform.
Yeah, so more questions coming in very much around that suggestion of, if we did move to the 30%, universal 30% that you came up with there, Rob. So, that would open the door for government to tinker with the rate as time goes on, which is a concern. We've certainly seen enough tinkering. And then if higher rate tax relief is reduced to 30% or tax relief overall is 30%, should it not be accompanied by abolishing the lifetime allowance? Probably get a good load of nods around the panel for that. Any sort of different views from DB and DC on that one, do we think?
Yeah, so from a DC perspective, I think for the annual allowance is probably a bit easier, so we don't get impacted by members that get good returns. I think that's a key point. But I understand from a DB perspective, it's almost the opposite. It's kind of like annual allowances. It's incredibly difficult for you. So
I think my idea of moving to 30% is a really good one.
Well, it's your idea, Rob. You're bound to like it.
but I think in terms of other changes to the tax system, yes, I agree. It would be easier for a DB scheme if you got rid of the annual allowance. To be honest.
Yeah, so I think it might be that we move to, ideally, if we're going to start making policy here on the sofa, that we move for something different.
Sofa government is back.
We move for something different for DC than DB, because I think it's got different issues. So I think that could be
I think we might yet get there, because, as you say, the issues are very different. Lifetime allowance is almost a penalty for good returns in DC. But then annual allowance is really awkward for DB. So, maybe we could move away from all of that. So other discussions, I mean, just really interesting one. Do we know how much tax is actually raised from the reduced tapering annual allowance? Is this extra complexity worth it? So we'll be putting everything down. So 4,000 rather than 10,000 is the minimum level. What actually are we going to get from that is going to make all of this worth it? I'm not sure I'm going to find anyone on the panel who's going to say, yeah, great, a bit more extra complexity, that's exactly what we need. But any thoughts on that from the panel?
Well, I can see it just looked like a quid pro quo, I guess, increasing the allowance so at a low level, so cutting it down more at a higher level. But I guess it was done in a hurry.
Yes, it maybe has that feel to it. And how about the complete inconsistency in valuing DB and DC pots against the lifetime allowance? How we do that? I think there's probably a lot here, and I'm getting that sense from the audience as well that we feel there could have been more done in this budget, and there hasn't been. It's been tinkering rather than scrapping.
And I think that's the frustration. It feels like tinkering on tinkering on tinkering, that we're going to go, admittedly this time it's just for higher earners that you will be communicating with the changes, hopefully. I just think it's every time you communicate the little bit of change to tax, it just erodes a little bit more trust. And actually, if we could just have one review, admittedly I know it's really hard, and I think government keeps putting it in the too hard to handle bucket, but if we could just have one review and then be consistent and stop going forward. I know I'm dreaming, but I think that would really help.
I think the challenge here is if you take the man on Mars view of life at the moment, most people are not even slightly engaged with it. And to be honest, that's usually the case when we get into some of this technical stuff. I think members at the moment and DB or DC, they've got other things in their mind, and so events at the moment largely supersede any kind of views on the tinkering. You know, it's just a car crash at the moment, and that's the way I think most people will kind of view it. But I totally have sympathy with everyone that's said, but I just...
I'd agree with that. I just think when we speak before this, when we used to get in the rooms with people and have focus groups, lack of trust is something that's constantly mentioned. And I think that was, you know, often with government, actually. Government was cited as one of the things that was, they didn't believe that they'd have the benefits, and maybe they don't, not everyone quite understands all the intricacies of the tax, but there is a trust issue.
But if you go back to before pension freedoms, for example, all the conversation we were having was about people saving more. That was what it was all about. And then after pension freedoms, it was all about how we can spend it better. And somehow we've jumped from there to there, and now we're coming back to how you can save a little bit more. But I just think at the moment people will not be engaged in that kind of conversation. That's the real worry, I think.
Short term, it's an issue whether they can carry on saving at the level they are doing, right? I mean, particularly if there's a big downturn.
But you could argue there's probably big opportunities to save right now.
Well, there are, agreed, but you have to have the wherewithal, right, as well. If your income dips because people aren't taking taxes or whatever it might be, then how do you deal with that? And it may be that we have to be more flexible in our approach to contributions for members going forward.
Correct, something like that.
I mean, one piece of work that Nest did, was Nest Insight, was around, could you set up a rainy day fund that sort of sat alongside the fund, the sidecar idea. And this is a sort of situation where that would really come into its own, it seems to me. In the local government scheme, there's an arrangement where you can choose to have a half contribution for a half benefit, I think. And I think those sorts of things could well be very, very necessary in the next few months.
Yeah, agreed.
Thinking about broader than pensions, isn't it? And having people have access to emergency savings is key.
Great. Well, we're coming to the end of our session now. So maybe if I can just go around the panellists with some very, very succinct final views, that would be brilliant. So Gregg, I'll go to you. You briefly were not on screen, but you're back on screen now, so that's fantastic. So very quick, 30-second summary, final views.
Yeah, he's frozen.
Oh. Frozen. Right, okay. Well, it kind of had to happen at some point, didn't it? Maybe we'll get Gregg back at some point. So I'll go to you, Rob, instead.
I think in terms of the budget, we've talked a lot about tinkering, whereas actually I think that we've moved a long way from simplification, basically. And I think, as Laura was saying, we just need to go back to that.
Chris?
I'd just say keep calm and carry on.
That's a good one.
Yeah, put yourself in your members' shoes, do some communications, think about your investment strategy.
So I would just sum up by saying we're probably going through the ultimate stress test at the moment across investment, governance, admin, communications, risk, and plan, don't panic.
Very good. Well, thank you all very much. So I think the consensus is quite a lot of missed opportunities to simplify things, interesting ideas around, what some of the future reforms of tax could be. Could there be winners and losers, some good and bad things, and also a lot of discussion from our panel about, how are we going to carry on our businesses in this difficult time, reassure members, do the right thing for them and for our pension schemes. So if we could thank the panel, I'm sorry we've lost Gregg now, but we will thank him in spirit anyway. So if we could thank the panel very much for this session. Thank you so much.